Technology crypto rallied the most if I just look down my Bloomberg right now. You know, the S&P is up 8%, the Nasdaq's up 25. I've been saying this since last year, and everyone thought I was crazy. The exponential age basket that I talked about in Real Vision that everyone thought was a complete idiot for, that's up about 40 this year. And crypto who everybody thought was completely dead is up 50, 60, and 70 depending on what you're looking at. Stuff like Solana's up 120. So this 50 correction in equities can't happen because simply they just expand the balance sheet and the denominator takes care of the 4 and they rise, so it just simply can't happen. The only way that it could happen is if we see massive quantitative tightening, but then the economy goes down the toilet and they've got the unemployment side of the equation, the inflation side, so it just can't happen right now. Now that's not mean this will stay forever, but it's a situation that quantitative easing is used as a way to pay the debts, and particularly the interest payments on the government debt. And that was again part of this everything code that everybody reset their interest rates to 0 in 2009. Everybody, every country, it was like a global reset. I only realized it recently that that was the global reset, and so everybody's now in this debt cycle of every 3 to 5 years of having to roll a debt. The interest payments get monetized, and that is the increase in the balance sheets. It almost exactly works out for the US, the UK, Japan, Europe, etc. They're all just the monetization of the interest payments. Forget about the 4-year Bitcoin cycle, forget about inflation and deflation, forget about whatever you think drives asset prices up or down. Real Vision CEO and macroeconomic investor Raoul Pal believes it all comes down to one thing: liquidity. Raoul has been working on his overall thesis that underlies all his investment decisions for a while, and he thinks he's cracked it in what he is calling the everything code. In a nutshell, Raoul believes that central banks and the Federal Reserve are stuck in a situation in which they can't let asset prices fall, and no matter what happens, all roads lead to more money printing over time. This leads to the debasement of currency over the long term. If you look at a chart of the Federal Reserve balance sheet overlaid with the stock market, it's essentially a perfect fit. However, with asset prices going up, two assets far outperform the others as they are further out on the risk curve. These are technologies such as FANG stocks or artificial intelligence, and the other one is cryptocurrency Bitcoin, Ethereum, and the likes. In his latest Ask Me Anything update, Raoul lays out the current financial climate, why he is 100% certain liquidity drives everything, and why he's betting it all on innovation, technology, and crypto for the next 12 months. Before we jump into Raoul's latest insights, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free, and you can always change your mind. Now, I've had a very strong view for a while, which was that liquidity was everything, and I wrote all of this up in that everything code that I've talked a bit about in that interview with Nathaniel Whiting-Moore. I went through quite a lot of what the everything code is, but that's still kind of exclusive to GMI. But liquidity is everything. All of my forward-looking indicators have been suggesting that liquidity is going to keep rising and that it would drive crypto and tech more than anything else. And that's basically been the story of the year so far. And I think that continues, and that's confused a lot of people. The one trade that's confused me is the bond trade, and that's confused a lot of people. Bond yields should have fallen by now, and they still haven't, but I think this is to do with the debt ceiling issue, which is the other confusing thing. Because the debt ceiling issue has some real risks around it, and we don't really know how to price them. All we do know is people are pretty bearish around it, and I think that's reasonable to have hedged around it, because we don't know what can happen. But the chances are that anything that causes a paralysis of financial markets will lead to that expression I always use: more cowbell, more stimulus to come. So I'm going to run through a couple of charts very quickly just to show some of the things that are on my radar screen so people can think about. So I'm going to start with my liquidity index. So this is the Global Macro Investment Weekly Liquidity Index that's basically around the G5 central bank balance sheets. We have our Financial Conditions Index, which is based around the dollar rates, and a whole bunch of other stuff, which leads this as does ASM, and it suggests that liquidity is going to keep rising all the way through this year, and the everything code suggests that it actually keeps rising all the way through to the end of 2025. So yes, we might have some stumbling blocks. Yes, we might have some hurdles, but liquidity going forwards as the economy slows down and the central banks start increasing their activity, that will drive asset prices higher. So that's the first chart I wanted to show you. So that's the liquidity chart. Why liquidity matters of this chart. This is the chart of the Nasdaq against that same liquidity index. That's the tightest correlation I've ever seen, and it explains 97.5% of all the movements in the Nasdaq. It is liquidity, and this is around this currency debasement idea. The more the central banks print, the more you're changing the denominator, not the actual value of the asset themselves. So again, the only assets that have really gone up in balance sheet terms are technology, the Nasdaq, and other like the exponential age stocks and crypto. Also, actually, interesting enough, so is luxury goods. There's a reason Bernardino is the richest man in the world. Is because what does he sell? He sells scarcity, right? In a world where you're devaluing the denominator, scarce things go up more in price. So Bernardino's balance sheet, his bank account goes up every week. So that's another chart for you to show, and then we can look at this, which is the chart of speculative positioning. Let me change that one and change it to this one. Now this is speculative positioning in the S&P 500. I have literally never seen anything like it. So the market is insanely bearish, which is why the Nasdaq's up 1.8% today. Because people just don't want to believe it. They're angry. They want the market to go down. They want their bear market, and they want their justice, and it's not happening. And the reason being is everybody's ridiculously, ludicrously short. On the flip side of the equation, we're going into this, and that's obviously driven by the debt ceiling. The other side of the debt ceiling is this chart, which is the speculative positioning in bonds. Now, bonds, as I mentioned before, have not been playing ball. I thought yields should be falling, but they haven't yet. But look what's going on here. This is the largest speculative short positioning in the history of the bond market. So, if anything changes at the margin here, we're going to see a gigantic rally in bonds, which I'm still expecting. But this whole debt ceiling dynamic is getting in the way. Inflation dynamics on the other hand, are falling very fast. Things like the Trueflation Index, which is a real-time calculation on-chain of millions of prices, suggest that US CPI as of today is 2.2% or 3.2%. I think it still goes to zero by June or July, which Alex Gurevich has been talking about both on Real Vision and also on Twitter as well. We're very in a small camp of that. We're also seeing wage growth coming down. We're seeing rents and wages are the most lagging of all, so they're all still to come down. So generally speaking, the economy is slowing. We've got this whole debt ceiling stuff that's getting people very nervous. The resolution of that, one way or the other, ends up being ongoing liquidity as the economy slows. The banking issues have slowed down for the time being, but that doesn't mean it's gone away. These things tend to come in phases, and so technology and crypto tend to outperform. Crypto's been consolidating for a while, but it's still up 50 to 60% on the year, still the best performing asset. But again, it's likely to pick up as liquidity comes forward, as shown by our forward-looking liquidity indicators. And we've probably got 20 or 30 different things we could show you to say that liquidity is going up. So I remain massively bullish. There will be a correction at some point in all of this as people start throwing in the towel in the short positions. Then we might get a correction before we continue to move higher. Later on in the summer, so overall super bullish. The only one that's puzzling me is the bond market sell-off. Us and play ball, but I think we need to get through this debt ceiling thing, and then a lot of hedges get unwound. Valuations keep going up, the market goes up. You don't really understand it. You don't want to get involved, so you stay out of it. You start to look for smaller opportunities and you miss the big thing. And it's only until I started to understand what was driving it that it was driven by this massive technological revolution going on, but also the Fed balance sheets and the global central bank balance sheet. Once I understood it, it became much easier to just buy it. And also, I also did a lot of work everything code to figure out that P ratios and being driven actually by the balance sheet and global and too. It's all monetary phenomena and it's not about earnings anymore. Everything is driven by one thing, and it is in the post-GFC environment. Is that why it's so hard for people? Just because the models that everyone was brought up on using are just not. They just don't function in that world where central banks. When I was just reading the FT just before we came on, and Carl Icahn says this 50% correction in equities can't happen because simply, they just expand the balance sheet, and the denominator takes care of the fall and they rise. so it just simply can't happen. The only way that it could happen is if we see massive quantitative tightening, but then the economy goes down the toilet, and they've got the unemployment side of the equation, the inflation side, so it just can't happen right now. Now, that's not mean this will stay forever, but it's a situation that quantitative easing is used as a way to pay the debts, and particularly the interest payments on the government debt. And that was again part of this everything code that everybody reset their interest rates to zero in 2009. Everybody, every country, it was like a global reset. I only realized it recently that that was the global reset, and so everybody's now in this debt cycle of every 3 to 5 years of having to roll a debt. The interest payments get monetized, and that is the increase in the balance sheets. It almost exactly works out for the US, the UK, Japan, Europe, etc. They're all just the monetization of the interest payments. So there's Raul with his update on markets and laying out his everything code. To be fair to him, this isn't a new concept coming from Raul. It's something he's been speaking on for 12 to 18 months, with it really coming to fruition over the course of 2023. We have seen this with the rise of AI and the vast outperformance of crypto and technology stocks in comparison to the stock market. But what do you guys think? Do you think there's more cowbells and more stimuli are inevitable over the next 12 months? Do you think crypto will continue to outperform? Let me know in the comments. Anyway guys, hope you all enjoyed today's video and that provided you with some value. I'll see you all on the next one, and as always, all the best. Thank you.